Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Market analysis, treasury yields, software short squeeze risks, and key stock outlooks. This video presents a direct informational narration of the source document. So, diving right in, on May 15th, we saw the NASDAQ index collectively decline by over 1%.
Looking at the broader picture within the S&P 500, the breadth was definitely leaning negative. We had 360 constituent stocks declining compared to just 141 advancing. And if you look at the sector breakdown, 10 out of the 11 S&P sectors actually trended downward. This pullback was really led by technology, materials, and utilities, which ended up leaving energy as the sole advancing sector for the day.
Naturally, large-cap technology stocks broadly declined, which really exacerbated that broader downtrend. But there were a couple of notable standouts. Among the major tech constituents, only Microsoft and Apple managed to post gains. Microsoft actually rose 3%, marking its largest single-day increase in a month. Now, while the storage sector experienced a pretty significant pullback, the software sector, which had been previously pressured, actually emerged as a surprising outlier, gaining over 1%. In fact, if we exclude Oracle, all of the top 10 constituent stocks within the software sector advanced.
So, what exactly drove this accelerated downward price action during late-day trading? Well, it was primarily driven by options expiration. A heavy volume of call options was closed out just prior to expiration, and this generated a wave of negative delta hedging that really accelerated the market's decline. You see, when a market exhibits this one-sided reliance on call options to chase upside momentum, and then that momentum falters, the expiration cycle essentially forces those long positions to close. This instantly converts them into short pressure. A very similar dynamic happens in the underlying equity market too. Long positions that were added at elevated levels end up triggering stop-loss selling during initial pullbacks. This leads to temporary sell-side imbalances and ultimately cascading liquidations. The key takeaway here is that sustainable, long-term upward trends require adequate consolidation and capital rotation. On the flip side, steep, unified rallies typically necessitate subsequent corrections once market consensus starts to diverge.
Now, evaluating institutional positioning. Hedge fund allocations to the technology sector still remain at extreme highs. This is justified, of course, by the sector providing the largest share of earnings growth. Total long and short exposure to the tech sector currently sits at the 100th percentile relative to the past 5 years. That's massive. Net long positioning is right up there at the 99th percentile, indicating near maximum capital concentration. However, capital support varies significantly when you look at the subsectors. While semiconductors are exhibiting very strong long exposure, the software sector is currently experiencing heavy short capital pressure.
Despite all this, it's important to note that the recent market pullback has not structurally altered the broader uptrend simply because no critical support levels have been breached yet. Based on the documented data points, immediate support for the S&P 500 is identified between 728 and 735. We'd really need a break below this specific range to validate a meaningful correction. For the NASDAQ, regional support is situated between 688 and 698. And for the semiconductor sector, support is noted at 489 to 507, with a secondary critical zone sitting between 533 and 552. Until these defined levels are definitively broken, the prevailing trend remains perfectly intact.
Let's shift gears to the macro picture. The fundamental driver of the current indices has been the significant earnings growth in the semiconductor sector, which has essentially offset EPS downgrades in cyclical stocks. However, rising inflation expectations and corresponding interest rate increases present a real systemic risk here. Long-term rate hikes exert downward pressure on technology valuations. So what we have right now is a core tension playing out. It's artificial intelligence-driven growth pulling in one direction versus interest rate-driven contraction pulling in the other.
To put some numbers to that tension, the 10-year Treasury yield recently surged by 2.43%, touching a critical downtrend resistance line that was established back in 2023. If yields break above this level and begin to consolidate near that critical 5% threshold, equity markets are expected to face substantial volatility. Historically speaking, sustained bond market sell-offs force risk-aversion behaviors in equities, so this is definitely a metric to keep a close eye on.
Now, within the broader tech sector, software presents a really unique dynamic right now. Oracle's performance, for instance, has been uniquely constrained by uncertainty surrounding a legal dispute involving an OpenAI stakeholder. This is something that could impact its financing and future commercialization.
However, the broader software space is heavily linked to artificial intelligence, and interestingly, is currently assessed as severely undervalued based on earnings data. Furthermore, the short squeeze risk in the software sector has accumulated to a 6-year high. Think about what that means. If capital rotates out of overcrowded, highly speculative semiconductor trades to lock in profits, a subsequent reallocation into this undervalued software sector could trigger a massive short squeeze.
So, pulling this broader market analysis together, we arrive at 3 primary takeaways. First, the immediate market decline is largely attributed to options expiration mechanics. It doesn't yet confirm a bearish structural reversal. Second, the 10-year Treasury yield requires strict monitoring because sustained elevated levels will introduce systemic pressure on equities. And third, the highly speculative semiconductor sector remains the absolute core driver of market sentiment. A substantial pullback in semiconductors could stall the broader market, yet at the very same time it could serve as the primary catalyst for a short squeeze in the software sector.
Turning our attention to specific equities, NVIDIA's upcoming earnings report is serving as a critical market node right now. While its recent quarterly performance is assumed to be stable, the market's focus is going to center almost entirely on forward guidance and upward revisions. Let's look at the forward valuation estimates. They project upside limits of 312 for January 2027 and 394 for January 2028. Now, if we base this on lower multiple assumptions, the January 2027 upside is projected at 234 and the January 2028 upside at 295. From a strictly technical perspective, the asset exhibits overbought conditions due to its rapid prior appreciation. A normal technical correction could actually target levels below 211, with absolute lower support situated at 175.
Looking at Microsoft, their current fiscal year concludes in June. Forward earnings projections for the company span from 441 to 592. The asset demonstrates an exceptionally high cost-to-performance ratio and is actually considered fundamentally undervalued right now, even when you apply median valuation multiples. However, its current price action remains suppressed. Why? Well, primarily because it's a major constituent of the broader software sector, which, as we discussed, continues to face systemic short-selling pressure across the board. Finally, let's talk about Tesla. The stock recently encountered some resistance, which led to position reductions among market participants who operate on wave strategies. But there's a critical emerging variable here: the potential SpaceX initial public offering. Media reports suggest the IPO might list on the Nasdaq under the ticker SPX, with pricing anticipated around June 11th and initial trading kicking off on June 12th. Naturally, this timeline implies we'd see a prospectus release by late May. Because SpaceX is currently a private entity, the cross-ownership and equity structures involving Tesla stakeholders remain quite opaque, and they aren't fully reflected on the balance sheets yet. Once public, the valuation of these holdings could significantly expand. This presents a really interesting scenario. It could be a bullish catalyst for a direct upward breakout, or, if the equity structure details are perceived negatively by the market, it could mark the current resistance as a definitive short-term top. For now, downside support for the asset is noted at 368.